Okay, let's bring in another voice in this conversation. I want to try to clarify what I was talking about. Ben Emons, Chief Investment Officer at FedWatch Advisors, must-read daily notes. Here's the point I was trying to make, casseroles aside, Ben, which is this. Let's say somebody's gambling on football, and they bet 5 games, $5, right? They don't care, and they win all 5. They get a little more bold. They start betting $10. They win 5 more in a row. Pretty soon, they might say, you know what? We're going to mortgage the house. I'm going to bet money I don't have because I can't go wrong. I can't miss betting on football. And I do worry there's a part of this market where that's where we are with stocks, that people have the risk has not gone out of the market, Ben, but I don't want people to get too confident, too cocky, too complacent, because that's when you get hurt.
Yeah, I think that's right, Brian, because, I described recently, like it's like a casino market, or at least it has some feel to it, right? You get speculators coming in that indeed, with a blind eye, just bet on something because it's going to go up either way. And so that casino element, I think, is playing out a little bit here at the end of the year, because those also probably the people want to take off the chips at the table really quick. So it adds a little bit of this downward momentum. So with the panel that we're probably going into the new year with some pressure on the markets, but keep an eye on what's happening with bonds too, right? We're having a pretty good rally today. I myself kind of bearish on bonds, but I do think there too, there was not a blind eye on bonds, casino there, really about fundamentals. I do think you get a little bit of a rally in bonds too to start the year.
Okay, a rally in bonds, but let me ask you the other side. Do you think it doesn't sound like you think we're going to get a 5% 10-year, but if we got close to that, Ben, because stranger things have happened, can the equity markets, quote unquote, I'm doing air quotes, survive a 5% 10-year treasury?
I think markets will be under pressure because at 5%, Brian, we may not even be, at 5 the high enough, because I think there's where the psychology comes in on those who are, I think, really overweight bonds. They start changing their minds, because I think that 5% represents what everybody has been pricing into the equity market, a stronger economy with more inflation and the Fed that only has to stay on hold and may have to reassess where they are. So I think that's going to be a pressure point there. Not to mention, we deal with this debt ceiling coming up in January. You can kind of tell during the budget resolution, and even today, there's some tension about this speaker and about what's going on with that the bond market could react to that debt ceiling negatively, i.e. going higher with yields after the short-term pullback that we're seeing here on yield. So I think it's a pressure point, Brian. It's something that we have to watch, because we're going to go to 5%. We're likely going to go a little higher from there.
Yeah, and Ben, your work has been extraordinary, and you've been one of the few people that thought that yields could go higher, correctly so. But what you're talking about in the very short term, I think, is tactical. In the TLT rallying into January, yields may be going down to 4.4%. But do you think that could be on the back of potentially a flight to quality as the stock market sort of sells off? I think we caught a glimpse of that a little today.
Yeah, I think that's right, Guy. I think that's the relationship that probably plays out a bit. People making note of economic data and surprising indices that those have curled down and yields have deviated from that. So there may be some reason here for people to say, hey, there's a short and tactical opportunity. But if you think about bonds and you think about the risk of bonds, and you think about the economy, we have too much duration risk still in these bonds. Each time yields go lower, that duration risk actually goes up.
What does that mean? Can you say duration risk Ben, in plain English for the folks at home on the radio that maybe new listeners and viewers, because the stock market has done so well?
Yeah, that's a good question, Brian. So think of the idea that if the yield of a bond goes up, the price goes down by X%. That's kind of what that duration measures. So duration 5 years, yield goes up by 1%, the price goes down by 5%. And actually currently today, that duration in treasuries is higher. It's more like 6-7 years. So talk 6-7% loss that you could have on the treasury bond if yields go up by 1%. That's actually what happened this past fall. I think that risk has not abated at all. If anything, any kind of short-term pullback in the yields makes that interest rate risk even more elevated, therefore future losses. So it's something really to keep in mind for people watching.